You scrape together the cash, hit submit on your final car payment, and own your vehicle outright. But instead of being rewarded, you get punished. You open your banking app expecting to see a pristine credit profile, only to find a massive drop in your score. Sometimes 20, 30, or even 50 points vanish overnight. It feels like a glitch. You paid back every cent you owed, exactly on time, fulfilling the exact definition of a reliable borrower. Yet, the scoring models react as if you just did something highly irresponsible. The math behind your credit profile evaluates a completely paid-off loan as a negative event. To the bureaus tracking your data, a debt-free consumer isn't a success story. You are a systemic error. By paying off that car, you objectively improved your financial health. You lowered your debt-to-income ratio and freed up hundreds of dollars in monthly cash flow. In the real world, you are wealthier and much less likely to go bankrupt. But FICO and VantageScore models do not measure your wealth. They measure the statistical probability that you will default on an active debt. And when you close a loan, you trigger immediate algorithmic reactions, specifically the credit mix penalty and average age shrinkage, compromising their ability to predict behavior. Every time you make a monthly auto payment, your lender sends a fresh, positive data point to Equifax, Experian, and TransUnion. The moment the balance hits zero, the contract is completed, the account is closed, and that active stream of data shuts off entirely. Without that monthly track record to evaluate, the algorithm treats you as an unknown quantity. And in the business of lending money, an unknown entity is mathematically calculated as a riskier entity. To understand exactly why your score plummets, we have to look at the specific rules these algorithms follow. The first trap is your credit mix, which makes up exactly 10% of a standard FICO score. This balanced scale represents what lenders want to see, a diverse portfolio. They want proof you can juggle revolving credit and installment loans. When the final payment clears, that account closes. Your profile is suddenly entirely empty on installment debt. Even though your balance is zero, the sudden loss of diversity makes you appear less versatile. The 2026 scoring models automatically dock your points for failing to maintain a balanced credit profile. The second algorithmic trap is the average age of accounts, or AAOA. This dictates a massive 15% of your overall FICO score. Notice the rhythmic pulse on this timeline. An active car loan acts as an algorithmic anchor. It continuously feeds your score a positive, on-time payment signal every 30 days, aging your profile. The day it's paid, the feed goes cold. While closed accounts stay on your report for up to 10 years, modern scoring models often apply less weight to inactive history. Removing your oldest active anchor shrinks your effective credit timeline, resulting in immediate score damage, an effect that hits particularly hard if you have a thin credit file. There's a final hidden layer to this math. Scoring models include an active management bonus. If you have an active installment loan and you've paid it down to under 5% of the original balance, the algorithm gives you the maximum possible points for highly responsible debt management. The danger arrives the moment you make the final payment to wipe out that last 5%. The account status abruptly changes from active debt management to inactive. The risk model instantly strips your bonus away. You lose those points not because you did something wrong, but because the algorithm prioritizes the predictable, ongoing management of active debt over a completed contract. Reaching total financial freedom removes you from the active playing field. You become invisible to a system expressly designed to measure how profitably you handle carrying a balance. Once you know the rules, you don't have to be a victim to them. You can apply specific system patches to protect your score while still managing your debt efficiently. The first tactic is the slow pay method. If your auto loan has a low interest rate, you can aggressively pay the balance down to that critical 5% mark, and then pay only the minimums. This keeps the account open, securing the active management bonus without costing you significant interest. The second tactic relies on buffer lines of credit. Before you make the final payment on your car, open a no-fee credit card. Even if you rarely use it, this establishes a new active revolving account to help anchor your average age of accounts before the installment loan drops off. The third tactic is pure financial arbitrage. If you have a cheap 3% car loan and $10,000 in cash, dropping that money onto the car saves you 3%, but putting that same cash into a high-yield asset earning 5% actually nets you a profit while keeping your active installment data intact. By utilizing these workarounds, you stop absorbing penalties for following the bank's rules and start manipulating their formulas to accelerate your own wealth. When you trace the math, the conclusion becomes clear. The credit system requires continuous, active borrowing to generate the data it sells. The algorithm doesn't drop your score because it's broken. It drops your score because it is working exactly as intended, incentivizing you to stay in the debt cycle. Before you submit that final auto payment, audit your active portfolio. Make sure you have other accounts in place to catch the statistical fall, and evaluate if closing that cheap loan is actually the best move for your bottom line. The rules of credit were written by the lenders, for the lenders, but you can outsmart them. Subscribe to join us and master the strategies you need.